Hello and welcome everyone to Calling All Real Estate Investors. We are here on the first and the third Tuesdays of the month for a live event with Caeli Ridge. You can reach us at info@ridgelendinggroup.com over email, or you can always call us at 855-747-4343. That's 855-74-RIDGE. And today we have a special guest, Daniel Paloscio, who Caeli, I will turn it over to her now to introduce.
Thank you, Miss Carly. I'm wondering, since we've got one participant here with us, my registration process was a little bit clunky. Normally we would have at least 2025 by now. I wonder if we should just give it a quick second and talk amongst ourselves before we really get started, just to give people a second to log in, because I don't think we've ever had just, yeah, here we go. I think they'll start coming in. So maybe I'll just sit here and listen to the soothing sounds of my own voice for a couple of seconds while we start getting some more people in here. Carly, I'll let you go ahead and manage those, and we'll just kind of sit here and look good, Danny, okay?
Easy for you.
Yep, they're rolling in here now.
Okay. Yeah, I may mention on the registration, I know what a freaking nightmare that was. We just, Zoom has the technology of it has eluded us on a few occasions, this not being an exception. Something had happened on the back end that none of us were privy to or aware of that broke the link that we'd been using all this time. So everyone having to re-register, and we sent out all of the notifications and tried to be proactive with it, but I had some issues logging on as the host. So it's technology. Yeah.
There you go.
My favorite. All right, let's give it another 30 seconds. The good news is, Danny, is that I would say the majority of people end up getting this information after the fact versus live. I thought we would have more people with us, but I'm so grateful for all of you that are here now. I'm stalling everybody because, as you know, you had to re-register to get on here, and I think that there's probably plenty of people that are trying to log in, and I'm trying to bide my time before we get going, and I'm just going to go. It's 1:32. Okay. Well, thank you guys for figuring it out and being here for us at the 1:30 mark. I am particularly excited to be with you today. I've got some, I think, what will be one of our more timely and beneficial, useful bits of information you're going to leave with today. Before we get into that, I always like to start with a little bit of housekeeping. So let me just get you that stuff. The 3rd of October, FYI, would be the first Tuesday of the month that I would normally have the live with Caeli. That's going to be a pre-recorded video for you that will be released the morning of the 3rd of October, that Tuesday. It's going to be about a new product that we have just recently launched that many of you, I get this question probably a few times a day, whether over the phone or in an email or whatever, about cross-collateralized lines of credit for investment properties. So that product is available. It comes with some fairly higher standards. So just be prepared to hear about that. But that'll be the 3rd of October, pre-recorded. It's going to talk about cross-collateralized line of credit for investment properties. So be on the lookout. And then on the 17th, that's going to be live. I will be remote traveling, but it will be live. And the topic for that's going to be how to prepare and what to expect for the year-end non-owner occupied investment property push. So any of you that have tried to get a loan closed for year-end tax benefits, and you started, maybe a little bit late, middle of November, even in December, what a mad dash that is. So we're going to go over some of the do's and don'ts of the year-end push for tax benefits on the 17th of October. And then lastly, actually maybe 2 more things. November and December, we're going to change up the schedule a little bit. I know that we are every other Tuesday. What is it, Carly? The 1st and 3rd Tuesday, 2nd and 4th?
1st and 3rd currently, yes.
Okay, 1st and 3rd currently is where we're at. Because of the holidays and some other variables, we're going to be changing the schedule up for November and December. Carly will be sending out announcements and reminders for all of that, so be on the lookout. And then the final thing before we get into today's meeting, masterclass for the all-in-one. I know that I've been promising that. I'm still getting lots of interest. I am working on it. And as soon as I can figure out the timing and come up with a syllabus, it'll be a regular, probably monthly time that we'll have together for anyone that really, really wants to spend in-depth workings about the all-in-one. So that's coming, I promise. Okay, let me get into this. Hopefully, I've got my notes here, so I don't know how many people we've got with us. I think it's probably inching up there. Okay, so I want to introduce you guys to a friend of mine, Mr. Daniel Paloscio, aka Danny P, DP, D Paloscio. I mean, you guys can choose. Danny's a good friend of mine. He and I go back, I don't know, Danny, what, six-ish years, I want to say, probably 6+ years,
20,
maybe.
2014, I think 2015,
Oh
longer.
my God, no kidding. Oh,
Yeah.
Jesus.
Yeah.
So then I could even say that, you know, I got to kind of watch him come up the rings here. I mean, he started, although I knew the minute he and I kind of started to talk that this kid was going to make something of himself. Very ambitious, extremely smart. It's been kind of fun to watch his evolution. We've funded some of his, well, more than some. We've funded quite a few of his investment deals over the years. And I'd like to think we helped him in his edification, educating along the way about the ins and outs and structuring some of his deals, and specifically the financing and the qualifying of that. He absorbed like a sponge how to master formulating Schedule E. That was something that we spent a lot of time on. Anyway, I'm really excited that he's here with us today. And I think that what he's going to share is going to create some significant returns for you guys. Now, before I really get into, I'm going to give you his bio, and then we're going to have kind of a real casual Q&A here. I want to share with you why I've decided that he would be a great inclusion of what it is that we talk about here. And I know that it's largely education based, but the reason that I found his what he's going to offer super useful, anybody that has spent any time with me one-on-one talking about your qualifications or your goals and your strategies, etc., you've probably heard me say as an overreaching or resounding bit of advice is diversification. Diversification within your real estate journey. Now, everybody's going to have their core structure or strategy, which is perfectly fine, but I'm constantly beating the drums about diversifying your portfolio. Single family, 2 to 4, cash flow, appreciation, short-term rental, long-term rental, mid-term rental, all of that stuff. And where that comes from, in those conversations, I may or may not have addressed or explained why I'm so fierce about telling my clients or investors that diversification is crucial in long-term success. And the why is because sorry guys, I don't know if you can hear that. I failed to do so when I just got into real estate investing. I was, mid-20s, I would say. God, that sounds like a long time ago. Mid-20s, and at the time, real estate is fairly cyclical, right? And in that cycle, it was all about appreciation. And don't get me wrong, we did extremely well. But I wasn't diversified. I was a one-trick pony, and as a result, I was one of the casualties, and I would say a pretty big casualty of the 08-09 crash. We got our asses handed to us, excuse me, in a big way. And if I had been more informed and diversified, I probably would have been able to weather that a little bit easier and without such great loss. So diversification, I guess, holds a important soft spot for me, and I want to make sure that anybody that is willing to listen understands how important it is. Enter Danny Paloscio. So one of the things, and I didn't mention in the outline I gave about some of the different variables in diversification, but that needs to include, or should include, if it doesn't already, private notes. Okay, where you kind of become the lender yourself. This is more on the true passive side. I know that for most of us, unless you're a fix and flipper and you got your hands on, real estate is thought of as a more passive type of an investment. But the truth is, it's not so passive, right? There's quite a bit of due diligence that we need to do, and even some micromanagement that comes along with it. But in this case, I would say this is, of all the different facets in real estate investing, this is probably the most passive. And if you align yourself with the right group, most passive and extremely profitable, I think you'll find. Anyway, so that is the why behind the how that we're meeting here today. And we've got Mr. Paloscio with us. I'm going to go ahead and read his bio, and then we'll get into some of the Q&A. I know you guys are going to have lots of questions. That's my expectation. As a result, I would expect that we'll probably run over the 2 o'clock hour. I've got until 2:30. So if you guys need to make arrangements or you want to be here for the whole thing or check us out in the recorded version afterwards, fine. That's the expectation. Okay. Mr. Daniel Paloscio is a seasoned private lender with more than a decade of experience in residential real estate. His track record includes over 600 loans successfully closed since 2013. This extensive experience in the industry has honed his ability to attract and underwrite high-quality, low-risk private mortgages, ultimately leading him to start SEP Capital. SEP is Suncoast, don't tell me, Equity Partners.
That's right.
Exactly.
Okay.
Yep.
SEP Capital. SEP Capital is a direct lender based in Tampa, Florida, specializing in high-yield, low loan-to-value private mortgages. SEP sources, underwrites, and services all the loans in-house. That's unique. Providing totally passive investment option for its lending partners. Prior to founding SEP Capital, Danny flipped single-family residents throughout Florida and founded Vacation Rental of Florida, a short-term rental management company, which currently manages $50 million in real estate around the state of Florida. Outside of work, Daniel enjoys spending time with his young family, his beautiful wife, and his new baby girl, traveling and working on his golf game. So without further ado, Daniel, thank you so much for being here with us.
Thank you. What an introduction.
Okay, so like I said, guys, I am not one that loves the PowerPoint and kind of just taking you through the motions. I like the casual and more collaborative conversations back and forth. So we have a list of questions that I'm going to go through, and Danny's going to answer them for us. As always, please use the chat feature, and if you want to unmute yourself, you can raise your hand, and we'll do it that way too. But let's get into some of these Q&A, and then you guys pose your questions, okay? Okay, let's start here, DP. Where does SCP Capital get its investment capital?
So we use what's called a co-investor model. And so a portion of the capital that's invested in each loan is my own. And then we source the rest through private investors to fill out the rest of the loan. So all of our capital is private money. There's no institutional capital, no institutional loans. And that sort of gives us the flexibility to move quickly and be real flexible with our borrowers.
So guys, just to kind of put a finer point on that, what that means is that he gets to make his own rules. And by private capital, he's talking about people like you. And just for those that need to hear this, I also want to reiterate, I don't have any dog in this fight. I am not profiting from any of this. This is just me in my own personal experience knowing that diversification is key, and I know and trust Danny. So for those that need to hear that, and that he's got his own skin in the game, right? So what I heard him just say, my takeaway there is that a large part of it is probably his own personal funds, and then the capital partners are you guys, right, Danny?
Exactly.
Yeah. So he gets to use, there's common sense is what my takeaway is. If there is institutional type of leverage or lending, there could be some missing elements of common sense that might otherwise be applied if he so chose, right?
Right. When you start, dealing with institutional lenders like, the Chiavis or, the lending, or they used to be Lending Home, but the Lima One Capitals, they're going to have sort of buy boxes or, specific criteria that they have to lend on. And so, a lot of the flexibility that we'll get, into will be with, significant collateral. A bank and an institutional lender would rather do a loan, at 97% loan to value with a borrower that has a 650 credit score, than they would with someone with a lower credit score at a 50% loan to value. And so we just try to, employ common sense, lending principles to, work with local investors that are getting on good deals.
That really is more risk-based or mitigating the risk, then, it's so funny that you bring that up, and I won't get off on a tangent here, but I'm an institutional lender, right? In a different fashion. And we have some private money and short-term money, et cetera, that we can lend on. And some of it does have common sense, but I'll give you guys an example. And this was a kind of a big headline a couple of months ago, and people were up in arms about some of the FHFA rules and the changes about giving lower credit score or less worthy borrowers some extra grace or incentive to get them into home ownership. If I don't know if that rings a bell for anyone, but it came through as if it would be penalizing those of us that have great credit and low debt to income ratio, et cetera. Point being is that in our industry, FHA, for example, doesn't apply to investors. It's only for owner occupied. They'll fund at 96.5% loan to value, right? How much skin do those guys have in the game? This much. And credit scores that are 600. I mean, you talk about risk, right?
Right.
When us as investors, we have to walk on water. And in Danny's case, they're talking about low loan to value, a lot of skin in the game for who they're going to be actually lending our money to. It doesn't make a lot of sense. I'll get off my soapbox, but in terms of risk, this is going to be from my perspective, on the much lower side from what is being bought and sold and traded on Wall Street. Anyway, okay, I'll shut up now. Okay, next question. Did you have something you wanted to add to that?
No, I think that's great. I think you're exactly right. It's a lot of people shuffling paper around with no real accountability. I mean, you saw it in 08. You got caught in that. My parents got caught in that. A lot of people I cared about did, and when people aren't invested in it personally, or when people don't have real skin in the game, you're just trying to move paper around and make as much money for yourself as you can, and so it doesn't really align the interests of those that are writing the loans and then those that are ultimately funding them.
100%. Well said. Okay, now this is probably at the top of everybody's list. What kind of returns do your lending partners make? Let's get into what everybody wants to know. What kind of returns can people expect?
So real simple, for the most part across the board, we're 10% yield to the investor. In some cases, we can range from 8 to 10, but by and large, our investors are making a 10% yield for investing in our private mortgages.
So guys, I mean, just for those that may not be totally clear on that, you're going to give 100,000, and I think that's going to be one of my questions too. Whatever the capital investment is, right? It's 8 to 10%, and it sounds like more often than not, you're going to be looking at a 10% return. That's not bad, especially right now, I would say. So
right.
We can dig into that. Let's see. So your lending partners are usually real estate investors, if you want to define, or if there's a profile of who your lending partners are typically. And then second to that question would be, what types of investors typically invest in private mortgages? Is there a profile?
To be honest, it really ranges. And I would say a majority of our capital partners some of them are real estate investors, some of them are active. All of them have a baseline understanding of how real estate works, which is why they like the asset class, if you could call it that. They understand what the value of a property is. They understand what loan to value is, and they understand sort of the risk associated with a low loan to value loan. So, we do, work with capital investors that range anywhere from, an average person in the workforce maybe making $60,000 to $80,000 a year to, professionals, in the workforce, like doctors, accountants, lawyers, some business owners. A lot of our investors are utilizing the funds in their, various retirement accounts, 401ks, solo 401ks, self-directed IRAs. But so the majority, the one thing that everybody has in common is that, everybody's looking for, like you mentioned earlier, a true passive investment. They're all, busy with whatever it is that they're doing throughout the day. They've made some good decisions, and they have, some capital that's sidelined, and they want to get a good return on it, but they don't want to be, answering phones to fix toilets at 2 a.m. They don't want to be actively involved in investment because they're either actively involved in their careers or they're actively involved traveling as retired people. And so they just want something that's safe, that gets a good return and that's consistent.
So my two follow-ups there would be, first, just for anybody that's listening or with us here, we keep talking about loan to value or low loan to value and why that's so important in terms of risk. And I don't want to steal your thunder here because I think it's one of my questions, but a low loan to value just means more skin in the game, right? So if we're lending to an individual that's got, 35% of equity sitting there on this investment property, are they more likely to walk away from that property or the one that they've got 5% of their own skin in the game in, right? So yeah, please.
Yeah, there's two parts to that too, because savvy investors frequently are getting, deals under market. So that loan to value, as far as we're concerned, comes from two places, and it comes from 65% being our maximum loan to value. I'd say that our portfolio now is somewhere around 58% LTV. But the other side of that is that we also, in most cases, are requiring a 20% down payment. So in a lot of our loans, we may be at 45% or 52%, so that we're sure that that investor also has a reason to stick in the game, like you said, because in the event that there's an issue, even if they're, really low loan to value, but they don't actually have their own money on the line, it's a lot easier to walk away from a deal. Investors aren't willing to really lose money. If they're in a situation where they may lose 10% of their own money, but they still have 10% of their own money in it, there's a lot more of a reason to see the project through versus if they're in it with no skin in the game, low loan to value. If things don't go right, it might not be worth it for them, once they start working. So once the deal stops working, so exactly.
Yeah. And then the second thing you said is about retirement accounts, solo 401ks, et cetera, is a good place. Because a lot of times when I start talking about this, and we don't participate in private notes. Okay, that's why Danny is here for you guys. We as in Ridge. But a lot of times when I start talking about that, it's just a means of conversation and making sure the client is well diversified. It comes with, well, I don't have that kind of money, right? Because they think they've got to have hundreds of thousands of dollars in their checking or savings accounts, when in fact that isn't the only place to source this. So for just the regular Mr. and Mrs. Jones that have retirement accounts that they want to look at that are accessible to diversify, that's a great place in which they can access to participate in this alternative means of investment. Okay, let's move on. We did the returns. I got that. Let's talk about what are the risks associated with capital investment in private mortgages? How does SCP Capital mitigate them? We talked about the LTV. What else?
So there are a few risks that are involved, just as is the case in any investment. So before we kind of get into those individually, I wanted to kind of go over how we sort of I don't want to say underwrite, but sort of the lens in which we look at each deal through. And that you guys have something similar, I think, in institutional lending, but we call them, the 4 C's. We have collateral, character, capacity, and credit. The importance to me in these deals is probably right in that order as well. So collateral, obviously, that speaks for itself. That's the value of the property, but not necessarily just the value of the property. It's the value of our loan against the value of that property. And so the lower the loan to value is on the loan, and the more that collateral value is worth, the more that can compensate for any issues in any of those other areas. That is the one thing that we will not budge on. And so you could have someone with the best capacity, the best credit, and who's the best person. But if there's just no collateral value there, if the loan to value doesn't make sense, then it's just not a deal that we're able to work with. So then next you'd have character, and your character is just what types of interactions have we had with this person? Are we getting good communication? We do in some cases pull credit, and that's not necessarily an important factor, but it tells a story. And so you look at all of those things, and then next is capacity. Do they have a track record? Do they have a history of completing these types of projects? Are they in the business in another capacity? Are they realtors, or are they contractors or inspectors? That speaks to their, ability to see the project through and ultimately exit the loan. And then last, like I mentioned, would be credit. And so, the biggest risks that you're going to sort of come up against in this business are going to be borrower default, market fluctuations, and then hazards. And so with borrower default, the biggest thing that we do to mitigate that is just having a low loan to value. And our mortgages and our notes are written in a way that if there is borrower default, as the investor, our position advances. And so we have default interest written into our loans, which could be anywhere from 18% to 25%, depending on the value of the loan amount. And so the next step would be foreclosure. And in 99% of cases of default that are going to go beyond an easy, quick correction, they're going to sell at the foreclosure auction. This business sort of years ago used to be known as sort of the loan to own business, where hard money lenders would lend on properties that, sure, I'll take back at any time. I don't necessarily, I do look at it in that situation, but I don't want to own properties. Investors don't want to take properties back. And so the goal for us is to work with good borrowers that are going to make their payments every month, that are going to get into good deals, that are going to exit those deals and make money. And then we're going to collect our capital and redeploy it. That's really what we want to do. That's what everybody wants to be involved in. And so we set these loans up in a way that if we were to go into default, our loan to value and the amount of money that we need to be paid back at the foreclosure auction is so low that in almost all cases, somebody's going to bid on it at the auction. They're going to get a great deal at auction. We're going to collect all of our late fees, all of the default interest. We're going to collect attorney's fees and any other fees, be made whole, and move the property. I think that the worst case scenario would be that we end up having to take the property back. And in that scenario, we would either fix and flip the property. As you mentioned earlier, I have a background in fixing and flipping houses, and we still have contacts with all of those trades. They do a lot of work for us in our vacation rental management company. And the other option would be, we could even put that property up for rent if we end up taking it back. And then along any default process, there's going to be tons of communication with the borrower. And that's why, character comes into play, because, in some cases, things happen, right? Sometimes borrowers have a lot of deals going on and they run into an issue. And so it's all about communication, and it's about negotiation and working something out that's going to work. You don't want to just kind of say, oh, you missed this payment, we're going straight to foreclosure. Because that, one, you probably could do it, but then that person's never going to come back to you again. Again, it's likely that they can get caught back up and things can progress as they're supposed to. So, outside of that, you've got market fluctuations. And again, I think the way we mitigate that is by having a low loan to value. If we're at 65% max and we lose 50% in the market, which would be an 08 or a 1930 crash, that's probably the worst case scenario. We're down 15%. And in those situations, you keep an open line of communication with the borrower. Maybe you negotiate a deed in lieu of foreclosure, which would essentially be us negotiating instead of going through the foreclosure process, and instead of that borrower having that on their record, because they all sign personal guarantees, they would essentially give us the property back. And so, a number of those workouts can happen. And then the last thing would be hazards. You have fire, you have flood, you have wind, especially here in Florida. And so we require that, all of our borrowers pay for 1 year hazard policies, including wind, at closing, so that they can't miss a payment and be kicked out of the policy. And then in areas where, there's flood hazards, we require flood insurance. And then we're also added to those policies as the loss payee. And so it's important to be the loss payee, because in the event that there is a covered loss, the insurance company is going to write a check with both of our names on it, my company's name and the name of the borrower. And what we'll do in a situation like that is we'll have the borrower sign the check to us. We'll deposit that check into our account. We'll give the borrower an initial draw against that, the insurance proceeds. And then as they fix the property, and as they make repairs and updates, we'll release more further portions of that of the the insurance proceeds based on draws and completion. And that just ensures that they don't get the insurance money, go to the casino, and then lose it. It ensures that the property gets it done, and we're always at a low loan to value compared to what's lent out on the property.
And you've got teams out there that are actually going by the sites and making sure that the draws are satisfied, or the work has been satisfied before the next draw is released.
Absolutely.
Yeah.
And because we do a lot of fix and flip loans, and so that's really basic template stuff for us. They'll call in a draw request. We'll send out our inspector. The inspector will go walk the property physically, look at any permits that were pulled, make sure that they're closed out, take pictures of everything that's done. We get that report back. And once that stuff's done, we send a wire, typically same day. So our draw process is pretty quick too. It's from start to finish. It's 1 to 2 days.
Gotcha.
Excluding weekends.
Yeah. I don't think this is part of our questions, but it came up in our discussion. Let's just say worst case scenario, you got to go to foreclosure. Okay. Everybody wants to avoid that. Obviously, with all costs, it's costly and it can take some time. But my follow-up question, I don't remember for Florida, but I believe Florida is one of those states that is more investor friendly. The process of foreclosure, obviously, like the back of your hand. Is there any quick nugget about that would be useful for as a worst case scenario, the process of fiduciary foreclosure? What is it again, Danny? It's there's two
judicial
different types. Judicial and non-judicial. So I think it's a judicial state.
We're a judicial state, unfortunately. A non-judicial state, I believe, Georgia, which is another market that we're looking at. We only lend in Florida right now, and that's because the state by state the laws can change drastically. But at any rate, a judicial state just basically means that it's a legal judicial process. You have to go sit in front of a judge before that anything can happen. I don't know what the term is for the states that aren't judicial states, but in those states, like Georgia, for example, it's basically an eviction. You foreclose it in some cases within 30 days. Whereas if somebody gets an attorney and they really fight here, it could be 6 months, it could be 8 months. And if you've made mistakes as a lender, it could be even longer. And so the biggest piece of advice that I could give to anyone that's going to go out and do loans themselves is to only do business purpose loans. We do not do any loans to consumers. A consumer loan would just be anything considered, if it's in their personal name, it's their primary residence, it's their homestead. There are some caveats that allow us to do, some of those loans, and that would be that for example, we can do primary loans on a refinance if the funds are going to be used for a business purpose. And in those cases, we get an affidavit signed by the borrower that says, hey, I'm using this money to invest in my business. But other than that, there are separate rights for primary residence owners or consumer borrowers, and that can really stall the foreclosure process for you. So we don't do any loans for consumers.
Excellent answer. Okay, let me move us on. What types of people are borrowing hard money, and why wouldn't they just go to a bank?
Sure. So I would say by and large, the largest percentage of our borrowers are going to be real estate investors, whether that's for fix and flip or BRRRR. And the reason is most lenders aren't going to lend on a property that can't pass a 4-point. And I'm sure all of anybody who's following you and watching this knows, that property has to pass a 4-point to get an institutional loan. And so
tell them what that is, just so that we have it on record.
Yeah.
What's a 4-point?
So if I cruising me here, but it's roof, it's electric, it's air conditioning, and
foundation.
Is it or plumbing? I think it's like plumbing, but it could be
Let's
foundation.
Make it 5-point. Let's make it 5-point.
Yeah. So all of those things have to be in good condition. And so, as most people that are buying properties to fix and flip, they need work. And so they're typically going to have a bad roof. The AC is not going to work. Windows aren't going to shut. There's a whole, list of issues that the problem has. And that's why the investors get in the deal. And same thing with the BRRRR investors. They're buying they're going to make the updates, then they're going to refinance out. Another type of investor that will use us for funding is just somebody who's got to close on a deal quickly. We get a lot of wholesalers that are getting these really good opportunities to buy property under market, but they've got really quick timelines, sometimes within days. I get a lot of calls from borrowers that they're actually scheduled to close with other lenders, and on the day before the closing, they're either changing the terms, or they don't have an appetite for that product anymore, whatever the reason is, and they come to us and say, yeah, hey, it's Wednesday, I've got to close Friday, can you make it happen? And so we do a lot of those loans as well. And then the other person that would get a loan for us would be business owners. There are a lot of business owners that own commercial real estate or a couple rental properties, and a lot of times they owe them outright, and they just need a little bit of working capital. And then I'd say the last person, the last type of borrower would be, I guess what you could dub the unbankable. Whether they may make a lot of money in cash, they don't necessarily have the tax returns to support it. The credit profile might not be great. Whatever the reason is, it's someone that wants to get into a property that just can't go the traditional bank methods.
Or maybe patience, right? I get a lot of clients that, well, maybe they could qualify, or it doesn't even matter. They just refuse to go through the gauntlet of what that means. And anybody listening on this that's gotten a loan ever, you know that it can be consuming, right? So, and I've got plenty of clients that say, no, I'm not going to do it. I need this cash for this amount of time. I'm going to pay what it costs, and then repay it just a short window of time. So could be that too.
Yeah. I mean, we're not the cheapest lenders around. We tell borrowers that all the time. And a lot of our people, we know that they work with other lenders as a first option. But what we'll tell people all the time is, hey, keep us in the back pocket, because every once in a while their person drops the ball and doesn't get the deal done, and we're there. And like you said, it is a hassle to get an institutional loan. Now, you're going to get the best rate with an institutional loan, and if you have a longer time horizon, then it's worth it. I've gone through several with you, and I don't think I would go through it with anybody else. I think in reality, you make the process a lot easier than it should be, I think. And you let me know what I need to get you, I get it over. But you told me when I did my first loan, you said, hey, this is going to be like drawn blood, so we're going to need everything, and you guys did. But I know the process now, and it's worth it. I have loans with you that are still at like 4% that I got when it was, I don't know, that 4 years ago, when the rates were 6.5%. So in those cases, it's worth it. But sometimes people have a shorter time horizon, and what does it matter for them if they pay a few extra points, on a 2-year note,
right,
to just be able to walk into the deal and not have a lot of paperwork.
Yeah. Okay, let's switch gears a little bit. Let's go. What does the due diligence process look like for you guys? What goes into all of that?
So, I mentioned the 4 C's. That's important. But other than that,
someone comes to you and says, "Hey, I need this for whatever the reasons are." Yeah, take us through that.
So, step one, I'm personally gonna speak with the client, kind of get a feel for who they are, what they know, what they've done, their track record, what their intentions are for the property. I'm going to get the address, and then I'm going to I'm going to look at the property myself as if I was the investor and I was doing the deal. I'm going to look at their scope of work on a fix and flip and make sure that what they're telling me, is adding up and it's realistic. From there, when the deal looks good, the next thing I'm going to do is I'm going to hire an appraiser. We get appraisals on all of our properties, or on all of our loans. A lot of hard money lenders don't. And it's not necessarily something that we have to do, but I like to have it in the loan docs for the investor to look at, and I like to have somebody else getting their eyes on it. We work with the same investors over and over, same appraisers over and over, depending on the market in Florida, because Florida is a big state. One of the appraisers actually was a mentor of mine when I first started flipping houses years ago. And so, our appraisers own rental properties. They fix and flip homes themselves. They understand, the nuances of each
they all don't.
individual neighborhood. They don't.
That's not true for all appraisers.
it's, people say it's an art more than a science, but I mean, it's a crapshoot, depending on who the appraiser is, what they feel that day. I mean, and so we don't rely solely on that, but it's just another piece of the puzzle. I'd say. Um, and then from there, we're going to pull the credit on the borrower. Anybody else that's going to be a guarantor of the loan. As I mentioned earlier, everybody, anyone who's involved with the loan is going to be a personal guarantor. And the reason that we do that is so that this person, we require that everybody do these loans in LLCs because we don't do any consumer loans. But that LLC may own no assets. And so if there's ever an issue of default, we want to make sure that the borrower's other assets are collectible that might not be held in that specific LLC. And that could be, if needed, it could be a car, a boat, primary residence. All those assets are on the table when someone signs a personal guarantee. And so I kind of got off track there, but okay,
due diligence, yeah.
Yeah, and so from there, then it's just going to, once the appraisal's back, once we have clear title, that's another important thing. Our attorney looks at every title policy. There's still things that surprise me, and so we don't do any of we don't do the final review of any of our title policies. Our attorney over at Anthony and Partners, who prepares our loan docs for each file, also looks at the title report, make sure that there's no surprises on there, nothing we need to worry about. Gets the title companies, which in our state, we're a title state, Florida, they get the title company to remove any exceptions that we need off. And once we have clear title, once we have the value worked out, we can close that same business day. So
wow, that's quick. And then
yeah.
I'm hopefully this is useful because I make the mistake. I've been doing this so long. I make the mistake and I assume that people just understand what certain milestones of a loan transaction or life cycle of a loan means. The title and clear title is super important for anybody that is not aware. This is where the attorneys in Florida, Danny's team, make sure that there are no encumbrances or liens or mechanic liens or anything that is clouding the title of that property, so that in the event of default, in the event of foreclosure, there isn't somebody that would take a first lien position. So if you had to sell it, right, or fire sale it or whatever, somebody else isn't in line getting paid first, or they're not coming to attach the property that could ultimately take it back when you've got this other lien. So free and clear title is a big one. Just anybody that may not be aware of that. Okay, let's see. What else? What time is it? What is the typical loan duration of these, Danny?
I'd say with our fix and flip guys, we're typically 6 to 8 months. We have some of our BRRRR guys that just sometimes just extend the loan year after year, but I'd say our average loan is 6 to 8 months. But we always have deals, loans coming in. We frequently have deals paying off every month, and so there's always opportunities for investors to roll that capital over into another project or another loan, or take the capital back at that point that the property's sold or refinanced.
Do you make sure that they have how do you scrutinize their exit strategy? So let's say that it's a BRRRR and hold, right? They're not going to sell it, they're going to keep it. How do you quantify if they're qualified or what their means are to get out of that loan in 6 to 12 months?
Great question. And well, we're going to pull the credit initially, and so the first thing is if they've got a 510 credit score, which I think I have seen one of those. Yeah. I know that it's not likely that in a year they're going to be able to refinance. We honestly will hold the notes. We're not looking to kick people out at the end of their loan, and we do have investors that when they sign up for, let's say, a 1-year note, they're only obligated to stay in that note necessarily for 1 year, right? If at the end of that year that investor does not want to hold the paper anymore and they want to pull the capital back to put it into something else, I would essentially buy that investor out of the loan before I foreclosed on the borrower for staying in the loan too long. But by and large, our investors just want to keep their capital to work as long as possible, and so we'll just, in a situation like that where they don't have a clear exit strategy, we're just going to make sure that the loan to value is low enough so that if there's any hiccups, we're in a good spot. But we honestly want them to extend into infinity. So
okay, all right, even better.
Yeah.
What types of properties does SCP Capital lend on?
So investment residential. So, single families, we consider as residential at 4 units or less.
Okay. Uh-huh.
Yeah. As long as it's for an investment purpose. And then we do everything else we'd consider commercial. So we do small balance commercial. I'd say loan size is under 3 million. And that could be, strip center, strip malls. That could be small apartment buildings. It could be, mid-sized apartment buildings. It could be, commercial, any
Mixed
commercial
use,
mixed
storage
use, yeah,
facility, as long as it
storage
made
facility.
sense. Okay.
Yeah, so our loan to values change quite a bit in commercial. So we're going to max out at about 50% loan to cost, and then on refinances, we get into the weeds on those types of deals just because the risk level is a little bit higher, and so you're really betting more on the jockey and on those small, or betting more on the horse, I think, and those small asset classes, smaller loan sizes.
Okay. Let's say, where do I want to ask next? This may be kind of obvious too. Private lender and hard money lender. Is there a minute just to define what is the difference? I mean, how does the lending differ between private and hard money for those that may be interested in that?
Sure. So a hard money lender would describe both a private lender and an institutional lender. So a hard money lending is essentially lending against a hard asset. So you want to be looking at the collateral more than anything else. A hard money loan is just a loan against, a home. It could really be against a boat or jewelry, but it's loaning against a hard asset. So what makes a private lender is someone who's lending money that's in their bank account. It's money that they directly control. And so they get to make the decisions on the money that they're lending out, or how they want to lend that money out. And so private hard money lenders all do business differently. You'll find that you could talk to someone who might do 100% financing on some deals. Other lenders, won't do it, right? Those are going to be but with institutional hard money lending, that's going to be your, like I mentioned earlier, your Kiavis, your lending homes. Those are the guys that are borrowing money many times off Wall Street, and in order to get that money, they have to agree to a specific criteria, and they have to tell their investors, hey, I'm only going to lend on deals that do X, Y, and Z. And so if it doesn't fit into that box, they don't do the deal. So there's really no negotiating. There's no flexibility. They are going to have the lowest prices. But honestly, since the Fed's been hiking the rate, the money that they're borrowing has gone up significantly, and a lot of those guys aren't much cheaper than what we're offering, and they're a whole lot more hassle.
Yeah, navigating a battleship in a creek, that paints a picture. Right. It should paint a picture. Yeah. Okay, a couple more questions here, and then we're going to find out how everybody can contact you. I probably should have had a slide for that I could have up here that people can write down, but you'll tell us. How do you make your money as a private lender? Or how do you make money as a private lender? That's the question.
Yeah, so a private lender can make their money in a number of different ways, but there's personally, we write all of our notes at between 12 and 12.99%, and we look to make a 2 to 3 point yield spread. So what that means is we write a loan at, let's say, 12%. An investor signs on to the loan at 10%. And we make what's called 2 point yield spread on that money. So if we have $100,000 in capital out, we're going to make $2,000 a year that money is invested. And then we also make our money through points. And our average loan is going to be 2 to 3 points. And a point is just 1 percentage point. So on $100,000, we make $1,000 for originating the loan.
Got it. And then I think finally here, oh, no. What is there a minimum investment size? That's a good one. SCP Capital have a minimum investment size.
Yeah, so I have an investor presentation that I sent you, and if you want to link that, people can take a look at it. It is going to say on there that we have an initial investment of $100,000. That's not really a hard and fast rule. A lot of our investors, like I mentioned earlier, have retirement accounts where they have odd dollar amounts, 26,000, and they just want to get it to work. We frequently take that capital on. And so, if anybody who's interested and didn't, have $100,000 per se to put into the deal, we actually do all of our loans to our investors as fractional participations. And so you don't have to take the entire loan. If a loan is $300,000 and you want to contribute $100,000 towards it, you have the ability to do that, and then the remainder would go to another investor.
Okay, good to know. Caeli, would you make sure that that presentation is available to the community post this recording? Thank you, dear. And then last question is going to be, if you want to summarize for us, DP, what are the benefits of investing with a private lender? Bring the house down, buddy.
Sure. I think the benefits of investing with a private lender like myself would probably be that it is a truly passive investment. Like I mentioned, we're handling the underwriting of each deal. We're handling the servicing of each deal. We're handling everything from start to finish. And so it's an opportunity for somebody who's busy. It's an opportunity for somebody who has, other things to do, to be able to place capital to work in a relatively lower risk investment, and then collect interest payments every single month. And then, the horizon on when these loans pay off is relatively short. And so you get to make a decision every, 6 to 8 months as to whether you want to roll that into something else or whether you want to pull that capital back. And so, especially in times like this where stocks are kind of up and down, I've got a lot of guys that have, kind of pulled back their capital, or what they have invested in their portfolios and done more hard money lending. And then when stocks look better again, then they'll pull out of the hard money loans and get it into stocks.
Yeah. The window is short enough that they can make those quick pivots and moves, which actually is another question that I don't know it was in this list. When does the payout occur? Is it annually? Is it monthly? When can the investor expect?
Every single month. We collect payments from our borrowers on the first of each month. We usually give it about 5 to 7 days to clear, and then investors usually get their payments by the 10th.
Excellent. Okay, my friend, then this concludes us. I would like you, if you could, for everybody that's going to be watching this, please let us know how we will find you, how we're going to reach you if they're interested for more information or to deploy their capital.
Sure. So the best way to reach out to me would be by email. That's Daniel at sepcapital.com. We've got the website at scpcapital.com. We're working on that now, so there's not going to be a ton of information. But the best way to reach out to me would be by email. I'm looking at my email all day long.
Okay. Yeah, he's very, very responsive. I thought I was responsive. No, Danny P is responsive. So we'll put all that up on the community as well, Caeli. And I'm assuming that the presentation too, Danny, has all the contact information, and if they want, right? Yeah.
It does. Yep.
Okay.
Phone number, everything's on there.
So gang, we have I guess depending on how much time Danny has or you guys have, I've got a little bit more time. Let's do anybody who's got Q&A. Do we have anything in there now? Open up for questions. I thought there would probably be a ton, but maybe we were so efficient that, we answered everything. Let's see.
I think there's 2 in here. I can see.
Yeah, we do have one from Tanya here. She asks, are you purchasing batch notes from banks? Are the investors able to choose which notes they would like to invest into?
Yeah, that's a great question. We're not buying any batch notes from banks or from other lenders for that matter. We're originating all of our own notes. And as far as choosing the notes, so we're not set up like a fund model. This is, like I mentioned earlier, a co-lending model. And so all of our deals are relatively going to be the same. So probably you could make the argument that if you don't like one of them, you may not like any of the others. But for the most part, you're not just giving us your capital and then we're investing it like a fund into all of our deals. You get to look at the package or the loan docs. You get to look at the appraisal. You get to look at the insurance docs. You get to look at everything. And if you like the deal and you're comfortable with it, you do that specific deal.
So they do get some voting rights in terms of where their dollars are deployed.
100% voting rights. Yeah.
That's unique. Wow, that's kind of cool. Okay, what else, guys? Anybody else have anything? Caeli, what else we got?
Remember, everybody, put your questions in the chat. And if you want to answer them or ask them out loud, just raise your hand and I can unmute you. Oh, let's see. One from Javier here. Is there a portal to see currently available investment opportunities?
We don't have a portal. As it stands now, whenever an opportunity comes up, I'm calling our investors personally and I'm putting it in front of them or sending an email. If you'd like to see what we have available, shoot me an email and then I'll add you to our list. And as something comes available, I'll make sure I send it out.
Good question. Come on, you guys, don't take it that easy on this kid. Let's go. What do you got? You guys don't have anything? Some tough questions for Danny? Anybody? Okay, we're going begging. Well, this was awesome, man. Thank you for taking the time. Really, really appreciate it. Again, diversification, people, for anybody that has any interest in learning from my mistakes and my wins, diversify, and this is a piece of it. Private note investing is definitely, if not feasible today, at some point in your real estate career, you should have this as a piece of the pie. And like I started the call, I trust this human implicitly. This is where I would put my money. Okay, so that does it. If you guys need us, Carly, you want to tell them how to get, you guys know how to get us, don't you? ridgelendinggroup.com, info@ridgelendinggroup.com, and 855-74-RIDGE is how you can pick up the phone and reach us that way. Thanks for being here. I'll see you guys in a couple weeks. Danny, you demand.
Thank you,
Thanks,
Caeli.
buddy. Okay.
Alrighty. Bye-bye.
All right, guys. Take care.